In this video, traders, let's look at the power of the outside bar. Stay tuned. Hey guys, warm welcome to you. Thank you so much for joining me. All right, so outside bar, what is it and why do I think it's a pretty powerful tool to have in your trading arsenal? So outside bar, you guys probably know this, but let's rerun it, revisit it quickly or rerun over it, whatever you want to say. Outside bar basically means, okay, we have a bar and this bar engulfs, sometimes called engulfing, the prior bar's range. So it could be on a 1 minute, it could be on a 1 day, any time in between. So it's basically saying, all right, the low of the previous bar was here, the high of the previous bar was here. So the next bar took out the prior bar's low and took out the prior bar's high. So it basically did range, engulf the range. Okay, so why is this so useful? Because this suggests sometimes there's a supply-demand shift. Okay, it suggests that, and especially depending on the direction it closes is super interesting as well. So let's say, for example, this bar here closed green. In other words, the close was at the high and the open was at the low. Or the open was somewhere in the middle and maybe it did a tail. Because very often you're going to get a bar that's maybe this, but actually you might get this kind of situation where it closes, but actually that's still an outside bar. That's not technically engulfing. Actually, engulfing is where the open and close is there and you've got the gap. But this is still an outside bar here where the low is below the low and the high is below the prior high. So you get a scenario where, hey, the market has taken out the low and then in the same bar has changed sentiment and swung all the way up above the prior high. Then all of a sudden that's something interesting, right? Not necessarily you want to be trading all of these things, but it's a little flag that goes, you know, look, something's happening. Supply demand is potentially shifting here. Pay attention. Where is this? What's occurring? Look at the other metrics that you should be considering. And is there a trade opportunity? So if you had this in the middle of nowhere, like an outside bar, it could be just chop, right? If you're just sitting there, market's chopping back and forth, you get that, you're like, I don't care. Who cares, man? It's nothing. But when you get that kind of movement, especially when it's a bar in the opposite direction, so let's say you're moving to the downside, or let's say you move to the downside is a good example, right? You go to the downside, and then you see an outside big green bar that's gone through the low, and now it's closing at highs, and it's quite wide range as well. That might be something that you go, hey, maybe there's buyers stepping in. Now, does that mean the buyers are going to continue to step in? You don't know, but it's something that's an alert. And if you're getting this outside bar down here, and I'm well out of scale, but you get the point after maybe you move lower and you get an exhaustion move, then you get an outside bar, you might surmise that, hey, is that the start of the buying? Is that the start of demand coming? Is that the start of supply shutting off? In which case, maybe there's a trade to initiate. We'll talk about as well why I think it's so powerful a place to initiate a trade. Maybe if you're looking at the bull flag scenario, okay, you're sitting there waiting, market's rallied up, it's pausing, it's consolidating, you're waiting for some sort of ignition, and then you get an outside bar. That could be the little clue. That sometimes is the little clue. That's why it's so powerful, because it's something that is very subtle, and sometimes you see it and go, there it is. If you're not watching tape, you're not watching time and sales, you're not watching the depth of the market, that sometimes alerts you and says, hey, maybe I want to jump on that, especially when it's in the context of a broader play. Like I say, if it's in the middle of nowhere, ignore it. It's not going to be any value. Same here, you've got a double bottom type trade, move lower, pushed higher, move lower again. If you're getting an outside bar kind of down here at lows after it's taken out prior lows, you might go, that looks like it's reasonable strength. And the good thing about these guys is that, like I say, with any of this type of stuff, it's not advice, it's not me saying you should do this, it's just something, a technical pattern, maybe to look into a little bit more. Because what you can do with this type of thing is you say, okay, there's the ignition bar, there's the outside bar, it's in line with something I'm looking at already. A very easy way to then structure your trade is to say, okay, bar's closed, I'm going to take it on the bar closed along, if we're taking it, all these along actually, and I'm going to put a stop under there, or I'm going to put a stop halfway there, or something. You can use that bar to structure the stop, so it gives you a lot. It gives you, hey, a heads up, potentially supply demand shifting. We don't know for sure, but it's a heads up that something interesting's happened, something different's happened, especially if it's in red, or pause, and then stands out like a sore thumb. It's like, bang, big outside bar. It's like, okay, something different's happening. Now, will it continue? Don't know, but it's an alert. It gives you a timing, like when the bar's closed and it's completed, there's my entrance, there's my entry to the trade. And the obvious place to have the stop and come out if it hasn't worked is if the bar fails. If it suddenly comes back and undoes all the work of the bar, it's a one-off market order or a bit of a flurry and there's nothing more to do. But the point is it the start of momentum? Is it the start of that momentum ignition? I talk about the momentum ignition triggers all the time. But is that the start of it? Is that the catalyst? And sometimes playing that in the right conditions can give you a really high risk reward ratio trade. You think you're risking one bar width and you might be holding it for 5, 6, 7, 10 bars. Then all of a sudden the risk reward ratio structure becomes quite good. And even if the probability of success is quite low, you know, if in the right conditions, it's not a bad thing to look out for, especially at the moment when we kind of see these swings and changes in supply demand structure quite a lot. So keep an eye on the outside bar. Very simple. There's nothing new here, guys. It's been going on for years. But when you put it in context with all the patterns that you perhaps know and love and are watching anyway in the market, and then you see these outside bars as an additional trigger, you're starting to compound layers of edge, layers of edge, layers of edge. And I say why I think it's so powerful is because you can structure the trade quite cleanly. There's no ambiguity. It's like, okay, there's the entrance, there's the exit. It's either going to work or it's not. And then the other addition you've got, of course, is when you're going to come out of the trade if it goes in your favor. But it's a nice starting point, right? Anyway, guys, outside bars. Let me know what you think about outside bars. You trade outside bars? Do you think they have a combination, or is there a powerful combination of kind of a couple of inside bars and an outside bar? Or do you like to use it in conjunction with a broader pattern? What's your favorite pattern that you would link the outside bar with? Is it double bottom pattern, the flag pattern, the exhaustion pattern? You know, what is it? Because, you know, I'm interested to hear what you guys have got to say, because sometimes you guys are seeing different things, you're watching different markets, you're spotting different opportunities. So share in the comment section below. Take care, guys. See you next one. Bye-bye.